One of the biggest benefits of owning investment rental property is cash flow. This is the cash you put in your pocket or in your bank account each and every month as the owner of the property. But if you want to make sure you actually have cash flow on a property, you first need to learn how to calculate it. The good news is the math is not that hard, and I'm going to show you exactly how to do it in this video. Let's get started right now. Now I want to say up front, cash flow is not the only important metric when you invest in real estate. For example, if you own a rental property and you have a debt or a mortgage on that property, just holding it, even if you didn't make any cash flow, and paying that debt down over time, that's called paying down your principal, could be a way to build a lot of wealth. Or if you buy a property and you buy it at one price and you can do something to the property like fixing it up or improving it, and you can increase the price of the property, or just patiently hold a property and let the market itself, let the property go up in value over time, both of those ways can make money for you even if you didn't make a lot of cash flow. And for a lot of you in high price markets, you might be saying, hey, I can't find any properties that cash flow, and you definitely have to make money in different ways. But I like to emphasize cash flow because it's kind of like an engine for a train that pulls along a lot of the other parts of your investment vehicle. And so cash flow can help you build money for cash reserves to help you sustain your investment over time. You can use it to save money to buy other investment properties. You can even use it to save money to do a rental debt snowball where you start paying your property off, paying your debt off even faster than the 20 or 30 years you have on your loan. So for all those reasons, it can be an investment boost to have cash flow, to be able to reuse it like that. And eventually you can also live off of it. So if you want to retire early, I wrote a book called Retire Early with Real Estate. And eventually having cash flow is what you need to be able to pay your bills and not have to work a job if that's what you want to do. So for all those reasons, cash flow is important, and it all starts with being able to measure it. So let's go take a look at how you do that. Cash flow is just an informal term for something called net income after financing. So I've got a very abbreviated formula here. I'm going to go into more detail in another example, but it's just the rent that you collect. So the total rent you collect minus something called operating expenses. This is going to include taxes, insurance, maintenance, management. I'll give you a comprehensive list in a moment. When you subtract those operating expenses from your rent, you get something called your net operating income, and then also abbreviated as NOI. And this is a really important formula to know in real estate investing. I've got another video just on net operating income if you want to check that out. Got a link in the video description. But you get to this number because this is the kind of cash flow you have before you pay your mortgage payment. So if you just paid cash for a property, or if you're trying to go and figure out a formula like cap rate or unleveraged yield, which I've talked about in other videos, you would want to use the net operating income. But we don't stop there. When we're trying to get our actual cash flow, a lot of us are using debt. So you're using financing to buy a property. And so you also subtract what's called your financing cost. And for now, let's just keep it simple. That's the total cash flow cost of you paying a mortgage. So this includes your principal and your interest payments. So some of that's going down to reduce your principal, but we just want to include all of it because we're looking at the cash flow, what's left over and goes into your bank account at the end of every month. And so when you subtract financing costs from net operating income, you get what's called net income after financing. So let me explain this a little bit more detail by showing you a more detailed formula and an example with real numbers. So I want to go into more detail about the formula for net income after financing, or cash flow. And so you're just going to start at the top with what's called gross rent. This is the total amount of rent that you're expected to collect. And you might ask yourself, how do I figure that number out? Well, some of the obvious places are if you're buying a property, look at what the property is rented for right now. That's a good indicator of what you could rent it for. It's not always the market rent though. Sometimes the best opportunities are ones where you can buy a property that's rented for below what you could actually rent it for. So it pays to study the market, to maybe have a property manager locally who can help you with their expertise at telling you what the property should rent for if you did this and this and that. You can also use some tools like online, like Zillow has a rental manager. You can use another tool called Rentometer, which I also use. Either one of those are free tools to try. I think Rentometer, you have to pay for a kind of a permanent professional kind of account. But in either case, it can help you figure out what a property rents for, and you're going to plug that in. Whether it's a house, whether it's a fourplex, you're going to plug that in to the gross rent. The next thing you want to do, and this is something a lot of people forget, is called a vacancy allowance. So this just represents the fact that you're going to be renting this property, but it's not always going to be paying the full amount of rent. So think about this. What if somebody moves out every 2 years and it takes you a month to get the property ready and to get somebody else moved in? So that's 1 month out of every 2 years, 1 out of 24 months that property is going to be vacant, and you're not going to be collecting rent during that time. So you need to make an allowance for that. Now, how much do you do that? If it were 1 out of 24 months, that's about 4 or 5%. So that's actually a pretty good number in my experience based on my properties. But there are other markets where there's higher turnover, where you might be like 8 to 10%. There'll be almost 1 out of every 12 months somebody's moving out. And then also other markets where I've had some stronger properties that are 2 to 3%, where we pre-rent them before anybody even moves out. They stay 2 or 3 years, and it's a lot easier. So you need to figure out what that number is. If you don't know a number, just plug something in so you at least have some kind of allowance. And what that's going to do is that's going to reduce the amount of money that you actually collect and rent. That's called your gross adjusted rent. That's what you'll actually collect. And then you want to start subtracting out your operating expenses. So what do those include? Those include things like your management fees. So even if you don't hire a manager, you self-manage it, you should allocate some kind of number here. That way, in the future, if you change your mind and you want to hire somebody to manage it, you will have analyzed the property correctly for you to be able to do that. That's essentially this extra cash flow for you if you buy the property and manage it yourself, but you want to put something in. So what do you put? I pay 10% to all my property managers. That's just the number that works for me. I know other markets though where people pay less, 8%. I know other markets where people pay more, like 12%, especially if you include like a leasing fee that some property managers charge. They might charge you 8% plus a full month's rent every time it turns over. So you need to figure out what that number would net out to. You can talk to a property manager and figure that out in your market. The next ones are property taxes and insurance. These are things you're going to need to look up and research in your area. You can look up in the public records what a property's taxes are right now. In most cases, you can call up to the tax assessor or look online and figure that out. There are also some calculators on a lot of tax assessor websites. My local one here in South Carolina where I am has that. And it's important to not take it for granted that what the current taxes are might not be what you are going to be paying once you buy the property. For example, what if a property, the tax assessed value is $200,000? That's what they're using to figure out the tax bill. But if you bought it for $300,000, they can automatically, in many cases, raise the tax value as soon as you buy it. So your taxes would be based on a higher value. And so it's better to try to figure out worst case scenario, or if they raise the taxes, what that would be. And that's why you want to use a calculator on their website, or best case, call them and try to get the information from them. Insurance is the same way. You want to ask your insurance agent. This is an important team member to have. If you're just starting, you're just going to have to call around, maybe start off with your current person who does your property insurance for your house that you live in, or maybe your car, and then just ask them to do that as well. But there's also specialists who just do rental property insurance, and you can talk to those people as well. Maintenance is a big one. So what is maintenance? I'm going to talk about two different categories here, maintenance and capital expenses. Those are both repairs to the property. Maintenance is more the ordinary things that happen on a regular basis during the course of business when you're renting a property out. These are things like if you have to cut the grass for an apartment building and pay somebody to do that, that's one expense. If you have a leaky toilet, that's going to be property taxes, property maintenance. But there's also turnover costs. So every time a tenant moves out, you're going to have cost that property is going to need to paint it, to clean it up, to get it ready. So all of those things fall under the category of maintenance. This other category that I'll skip right to here, capital expenses, is one that a lot of investors forget and they don't take into account. And this is that if you have a roof, a heating and air, a driveway, really any piece of the rental property, at some point it's going to wear out. It has a lifetime and you're going to have to replace it. So this won't count as your ordinary business expenses, but every 5 years, you're gonna have to, or 10 years, you're gonna have some of these big expenses that you're gonna have to pay for. Those are called capital expenses. And it's a whole nother topic. They're treated a little bit differently on your tax return. You might not be able to deduct it all at one time. But if you have a $10,000 roof expense, from a cash flow standpoint, you want to make sure you allocate some money for that. So for both maintenance and capital expense, it's going to vary depending on how old the property is, how big it is. But I have typically had $50 to maybe $150 per unit. That's one way of looking at it. I also like to do about 7.5% of the total rent for maintenance, and maybe another 5 to 7.5% for capital expenses. And I'll just tell you, that's a lot higher number than a lot of people are putting in, but I've done my numbers. I've run the numbers on all my properties that I own, existing properties, and a lot of them have been in that range. Very few of them have been below that. That might just be the way I manage my properties and we spend more money on them, but you don't want to underestimate it. You'd rather have some kind of number allocated there and then than being surprised later on and saying, I don't have enough money or I'm not making as much cash flow as I thought. Let's move to utilities. If you have an apartment building, you might be paying the utilities for like the water bill for some of your tenants. Maybe you pay some public lights, like some lights for outside the property or something. If it's a house, you're probably not going to pay the utilities. Your tenant's going to pay that themselves. And then there's always miscellaneous, right? I have business licenses and rental licenses in my town. So you need to call up the licensing office, find out what kind of licenses are required. I have to pay $100 per unit in my town for a rental license. That's a little higher than some of the towns around me, but that's the deal. You can't rent a property unless you have that license. So all of these fall under the category of operating expenses that I summarized in the last slide. But then when you subtract all those operating expenses from your gross adjusted rent, you get your net operating income, your NOI. That's the amount of cash flow you're making before paying your mortgage payment. So we want to also deduct that though, your financing cost, which includes your principal and your interest. You can use an amortization calculator or a loan calculator. Look that up on Google to find some good ones. But you just plug in whatever your loan amount is, and then the calculator will tell you what your principal and interest payment is. So all of that will tell you your financing cost. And so you subtract your financing cost from your net operating income, and you get your net income after financing. This is the bottom line number of how much money you're putting into your bank account. I do want to make a point here though, that this is sometimes not the final number. It's a really important number. It is a cash flow number, but it doesn't take into account that you have to pay income taxes. And I'm not going to cover that in this video. If you want me to cover income taxes and kind of take this a step further in another video, let me know in the comments. I'd be happy to kind of dig into that. But every situation is different. Every person has a different tax rate depending on all your other income. It also depends on how much depreciation you get on this property, how much shelter you'll have from some of the depreciation expense. And so you need to take all that into account. It's just a little bit more of a calculation to figure out how much you'd actually have to pay in tax. And that would be another deduction. You need to make sure you know how much you're going to be paying in tax to figure out how much you actually get to keep in the end. So that is a summary of all the cash flow. I do want to talk about next though, what is a good cash flow for a rental property? And we'll talk just a little bit about that so you can make some judgments when you're looking at your own rentals. So I know many of you are probably asking the question, well, how much cash flow is good? What's it take to make a good deal? And so I'm going to give you that very unsatisfying answer of it depends. It does depend on some things. Number one, it depends on how much cash you put down. If you put 100% down on a property where you don't have any financing, then you're going to want to make a lot more cash flow than if you put a very small amount of money down. So that's one part. And we're going to talk about another formula, and I've done other videos on that called a cash on cash return. The more cash you put in, the more important that cash on cash return is, so you can keep yourself honest and make sure you're getting a good return on that amount of cash you put. Because if you had $100 per month in cash flow, and maybe normally you thought that was a good deal, but you had $100,000 invested, that would be a very small cash on cash return, like a 1.2%, which you can do even better than that, in some other types of safer investments or less hassle investments. So the down payment is one part of it depends on. The other part is you have to look at a whole analysis of a property. Cash flow is very important, but there's a total return that you're often looking at. So cash flow is one component of it, but then there's other profit sources that I talked about earlier, like appreciation, principal pay down. And so you have to balance those out. There's some deals that make a lot of appreciation, a lot of principal pay down, but very little cash flow. There's other deals that make a lot of cash flow and very little of the others. And so what you're looking for is a total return. And so that's why it depends. Like in general, maybe kind of a generalization, some of the high price markets out there, California, New York, some of these places, they're very appreciation dependent and very little cash flow. So even if you paid cash for a property, you might make like a 3% return from the cash, and you maybe make a 5 to 8% return from the growth of the property. So maybe your total return is 8 to 10%, or what is that, 8 to 11%. Whereas you look at another property, maybe I'm in a more rural area that has fewer people and has less growth potential. Maybe it has a 7% cash return and maybe a 2% growth rate. So maybe that return is 9% total. But what you want to know is the total return. And you might choose to invest in properties that have more cash flow. Maybe that's just your choice. You'd rather use more cash flow. Other people might say, you know what, I don't want the cash flow right now. I just want the growth over the long run. It's more tax efficient. It makes more sense for me. So that's why there's different investors who have different priorities. So it depends. What's a good deal? I'll still give you a number because I know it's nice to have when you're a beginner to say, what's a good number? if you're in a more cash flow oriented market where you are kind of focusing on that, at least making a couple $100 per month has always been one of my goals. So if I'm making a normal size down payment, 10% down, 20% down, if I'm not making $200 per month, just as a raw number, it's probably not something I'm interested in. For a large deal though, if you're looking at a multi-unit property, maybe you're buying 12 units, maybe it's $100 to $200 per month, you still want to make some kind of cash flow. So those are some basic starting numbers. Again though, when you're analyzing a deal, it's kind of like you're going and flying an airplane. You have this dashboard with all sorts of gauges. Cash flow is one gauge, is one way of measuring it. Cash on cash returns, another way. There's also other formulas that I use a lot, like an unleveraged yield. That's kind of a nickname for a cap rate is something similar to that, if you've ever heard of that. An unleveraged yield is how much return would you make if you had no debt on the property. So I look at all these different formulas, and I have a video you can check out, my back of the envelope math, just to look at how all of those fit together. So you can there's a link to that in the video description, but you want to look at all of those together along with cash flow. And if cash flow is your most important priority, then of course, prioritize that as well. If I had to give you a main lesson, a takeaway from this entire cash flow video, it's this: be real with yourself. Be honest with yourself about what your cash flow is. That's the main reason to know all the details of this cash flow formula. I can't really tell you whether you want a certain amount of cash flow or another amount of cash flow. That's gonna be something you're gonna have to decide for yourself based on your market, based on your personal needs. But no matter what, you gotta be honest with yourself. You gotta run the real numbers. I've seen so many investors who get into a deal 2 or 3 years later, myself included, and they realize that the cash flow is not really what they wanted or they thought it was up front. You've kind of pulled wool over your eyes, you've deceived yourself, and that's the worst thing you can do as an investor. At least be honest with yourself up front. You can make a choice to make less cash flow, and maybe that's okay with you, but just know the numbers, be clear with yourself, be honest with yourself, and you'll have a much better real estate investing experience in the end. Did this formula for cash flow make sense to you? Is this something you can use in your own real estate investing? I would love to hear from you in the comments below if you have any comments or questions. And if you like this video, be sure to smash the like button, give me a thumbs up to help me spread the word on YouTube. If you're new here, be sure to hit the subscribe button and the little bell so you don't miss anything. I have new videos that come out every Monday morning with my podcast episodes, and every Friday, shorter videos just like this. And don't forget, if you want a copy of the free cash flow spreadsheet, there's a link below in the video description where you can just put in your email address and I'll send that to you for free. So you can use it in your own real estate investing business. If you like this video where I go over the numbers of how to calculate cash flow, I think you'll like my next video where I go into a lot of detail on my very first rental property 17 years later. And I show you not only the cash flow, but all the other numbers of that rental property if you look in the past. So you can see the real numbers, how it actually worked, the good, the bad. I open it all up for that one rental property. And you can check that out just by clicking on the video link in the description. You also see something above me here where you can click on it as well. You've been watching Coach Carson TV. My name is Chad Carson. You can also call me Coach, and this is a channel all about investing in real estate, achieving financial independence, and doing more of what matters. See you next time.